Friends, I welcome you all to our today's session. So, as we have planned, we'll be discussing about the principles of insurance, which you already know. Initially, we had discussed about this. These are the various principles of insurance, and you already know there are basically how many principles? Seven principles. Is it that? Seven basic principles are there, which are relevant in any insurance policy. As all of you know, when we talk about insurance policy, this is basically a contract, and it is a contract between two persons, or you can say two parties. And if you remember, the two parties involved as called as, one party is called as the insurer, other party is called as the insured, right? The insurance company or the uh, uh, person who is providing, or the party who is providing that service, that party is referred to as insurer, right? And the person who is availing that policy or availing that insurance service, that person will be called as insured, right? So, if I show you one policy right now, just an example of policy, you can understand. Just give me one more second. Yeah, a similar kind of policy I had shown you earlier. You see, suppose you see this is a policy paper, or you can say this is a certificate, policy certificate. As you can understand, so what happens in this kind of insurance policies? What is important is that it is valid for a particular period. If you see, if you look at here, this policy is valid for a particular period, right? That means if the uncertainty means the event which is insured happens within that period, then only compensation will be paid. Now, who will be paying that compensation? The insured will be paying that compensation. In this example, we are talking about this company has provided the insurance service. That's Universal Sompo General Insurance Company Limited. So, as you know, or we'll be discussing after some time, that the broadly we can classify insurance policies into two categories. Of course, there are various types of policies out there. Each insurer or each service provider provides various types of policies, right? If you look at their menu, you can find out so many types of policies out there. But broadly, we can group them. Some policies as called as the life policies, that the other policies can be referred to as non-life policies. The example I was showing you, that was a kind of vehicle insurance or a motor insurance. That's a life policy or non-life policy. Whether that will come under non-life life category or non-life category. Can anyone guess?
So non-life.
Non-life category. Okay. Now, can you tell me some of the examples of non-life insurance you might have heard? Let us say vehicle insurance is one kind of insurance. Some other insurance which are non-life. You might have heard in your day-to-day life, we hear about this kind of policies, these kind of insurance contracts. Can anyone tell me?
So house insurance?
House insurance. Okay, that's also an example of non-life policy. What else?
Sir, property insurance.
Property
travel insurance.
Sorry, travel insurance. Right?
Yes, sir.
Okay. So even health insurance, health is different and life insurance is different. Okay. Then what else? Any other example?
Sir, factory insurance, warehouse insurance,
Warehouse
transportation
insurance.
insurance.
Yeah, now you have understood that if you look at a non-life look at the menu of a entity who is providing non-life insurance, you can find out several types of insurances. Okay, like or we may think of something like group insurance. You might have heard it is provided to a group of persons. Okay, that is another way of classifying insurance policies. Group insurance. One more kind of insurance may be called as a reinsurance. That is again something insure. That means that insurance company is reinsuring the risk with another insurance company. Reinsurance, that is one more type of insurance. Like this, various kinds of insurance policies are there. Similarly, coming to life sector, if you see, okay, life sector, can you think of some of the sub-classification or types of life insurance policies? Anybody knows it? Life insurance policy also, there can be various types of policies. In fact, you may do a research. You may visit to any service provider's website and find out their products. So many products are there. But broadly, we can classify something like this. Some of the policies we can report to us, let us say, the term insurance policy. It is for a fixed policy, or like say something like endowment policy or whole life policy. So these are various
Sir,
types.
ULIP like that.
Yeah, ULIP. Okay, so that is in fact a scheme which is linked to mutual funds. So it is, you can say it is a mutual fund which is linked to insurance. Okay. So this is again one more investment product. So that is different thing, a hybrid product you can think. Right. So those kind of products are also there in the market, hybrid products. Okay. So it is an unit as well as an insurance product. Unit means it is a mutual fund. Plus, there is some insurance element to that also. So that is also hybrid product. You give a good example of that. So like this, various products are there. But when all the products are there, the basic thing is that when the product, this kind of contracts are entered into, this contract is subject to so many terms and conditions. You must have seen when you do a product, let us say when you opt for choosing an insurance policy, or if you want to enter into a contract for insurance, you'll find that so many terms and conditions are there. You have to agree to that, and you have to sign a paper that you have agreed to all these terms and conditions. In fact, what exactly happens in insurance policy? In fact, let us say you are going to take a policy. That means what is happening? You are giving a proposal to the company that you want this kind of insurance policy, and the company accepts them, or the insurer accepts them. After that, only you become the insured, and the insurance company becomes the insurer. Right? So many terms and conditions needs to be complied with. That is one thing. But apart from that, what is more relevant is that this insurance contract are subject to certain principles. And these principles are fundamental. Fundamental in the sense, if the principles are violated, that means insurance company may refuse to pay the claim also. Okay, because these fundamental principles are not complied. That is why these principles has got so much of importance. So you are aware of most of these principles. So let us have a recapitulation of these principles. So as you know, or as you are discussing, the objective of all these policies, this insurance coverage, is to have a kind of protection against the financial losses, which may happen due to some uncertainties. So therefore, since it is intended only to seek protection against some losses, it should never be misused. That is the intention. The insured should never try to seek profit opportunities out of this. Only when loss is suffered because of certain event which is insured against, he can be compensated. But he should not seek any profit. Okay. There should not be any breach of trust between these two parties. Two parties means insurer and insured. Okay. Both the parties should believe each other. They should disclose all the relevant facts. And in case the insurance company has doubt about the insurance claim, then he need to investigate how the policy actually, what happens exactly. If you see, the insured pays the money which is called as the premium, and a particular event or particular loss is insured against for a particular sum, that is called as the sum assured. So normally what happens, the insurer or the insured pays a very small amount, but coverage amount is big, sum assured is big. Why it is so? Because the possibility of happening that event is maybe, the probability of happening that event may be quite low. Right. So in case that doesn't happen, then insured may not get anything. Right. If that is the situation, if this is the situation, these policies are available, or these insurance contracts are available by the insurance company only with the intention that these people who are suffering they may be compensated. So if the claim is not genuine means actually loss has not happened, but the insured has claimed it. Then insurance company has got every right to investigate. And in case it is found that there is fraud, actually false claim has been made, then insurance company may go to court of law and may charge penalty for this. So not that only compensation will not be paid, penalty can also be levied in this kind of situation. Now, friends, so we are talking about the insurer must investigate about the doubtful claims. That is one thing. But at the same time, insurer should promptly pay the genuine claims. The claim is genuine, it should be paid as early as possible. Of course, IRDA has control over this. IRDA monitors that what is the normal time with which by which the claims are disposed of. If claims are outstanding for longer period, IRDA questions insurance company on regular basis. So these are the basic things. And these insurance contracts are subject to these fundamental principles. All these principles are fundamental, as you can see, as you can read it. They are called as the principle of optimum fide, principle of insurable interest, principle of indemnity, principle of contribution, principle of subrogation, principle of loss minimization, and the principle of causa proxima or nearest cause. Okay, so we'll be discussing about all these things, and we'll not only will be discussing, we'll try to find out some example for all these things. That is the objective of this session. First principle is utmost good faith, principle of utmost good faith or principle of optimum fide. So friends, let us think of it. If you think of some example that how utmost good faith is used. So you think of some situation. Let us say when you are going for health insurance, normally there is a requirement that you have to mention that whether you are suffering from high blood pressure, etc. So what should I write? You should give the fact. Suppose you are suffering from BP. Should we disclose that thing or not? Or should we ignore or not? This is a small thing. I will say no, so that policy amount will be little less. Ideally, what should you do? Let us say someone is having high blood pressure and is going for a health insurance policy, and the policy clearly asks, are you suffering from hypertension or high blood pressure? What should he do? He should disclose it, right? Yes or no? Can anyone reply?
Yes, sir.
Yeah. So what should he write? He should write yes, is it not? He should clearly disclose, because if he is not disclosing and later on it is found that a material fact has not been disclosed, then on this ground also insurance company may reject the claim because the principle of utmost good faith is not maintained. Okay. So like this, many issues are there. In the health insurance, again, questions are asked. Suppose, have you faced any surgery earlier? So you have to disclose what is right. Okay, similarly, not only that, at the time of claiming money also, suppose in case of motor insurance, right? Whether the person who was driving was having valid driving license or not. So one should disclose that thing clear, whether he was wearing helmet or not. So if these are not disclosed and later on it is found that the person has not disclosed the facts, that means that itself shows that the fundamental principle of optimum fide. Friends, sorry, we got interrupted. Yeah, so this is what we are talking about, that in this kind of situation, when the principle of utmost good faith is not followed, then insurance company or the insurer may challenge the claim. So therefore, that is it. Okay. So As you know, this particular phrase of prima fidei uh, is a Latin phrase. This means utmost good faith. When the contract is signed, this contract must be signed in absolute good faith. So both the parties, the insurer and insured, should disclose the complete information which is relevant for the insurance policy. The insurer's liability gets void if any fact or subject matter of insurance is either omitted, hidden, or falsified. The entire thing becomes void. Okay. Uh, so if this particular principle is violated, contract may become void. And one more thing you have to keep in the mind: if there is some small error, let us say, which is not material, the contract may not be void. So this particular principle is applicable on material facts. If the facts are material and utmost good faith is not maintained, the contract. Therefore, it is a duty to disclose everything uh, faithfully. Second principle is insurable interest. This also, we know this thing. What is the meaning of insurable interest? That means the person who is going to take the insurance policy should have some insurable interest in the subject matter which is insured against. For example, let us say you are owner of the vehicle. You can take an insurance against this. Because what happens when so long as vehicle is with you, you are gaining something out of it. If vehicle is not with you, you'll be losing. There will be some financial loss. If vehicle is damaged, you'll be facing some loss. Therefore, it is understood that you are having some insurable interest with the subject matter. Therefore, you can take an insurance policy against it. Can you think of some other example about insurable interest? Quickly. So normally, friends, you see, when there is in this this concept of insurable interest is very closely related to the concept of ownership. If the person is owner, so it is assumed that he is having some insurable interest with the subject matter. But it is may not be always necessary. Without being owner, somebody may have some insurable interest, maybe on some asset, maybe some property, maybe some event. So in that case also, one can take an insurance policy against that subject matter. Right. So that is the second principle. The person who is getting insured must have insurable interest in the subject of insurance. Okay. Insurable interest is there when physical existence of the insured subject gives some gain and non-existence of that subject gives him some loss. The example I gave you, suppose someone is going for motor insurance, which when the car is there, he's gaining. When the car is not there, he's suffering some financial loss. Therefore, insurable interest is there, you can say. Third principle is the principle of indemnity. Principle of indemnity means, so the insurance policy is for protection against some damage, loss, or injury. Okay, it is not for earning any profit. If you have not suffered from any loss, then you cannot claim anything. And the claim amount is also limited to the amount of loss suffered. Okay, no one is allowed to make any profit out of insurance. So that is the principle of indemnity. Okay, so the policy is intended to pay compensation. Compensation has to be paid in proportion to the incurred loss. On the basis of the loss, compensation has to be paid. And compensation amount, as I told you just now, is limited to the amount of loss suffered. Compensation cannot be more than the actual payment. Right? Compensation is not paid if the loss doesn't happen due to some specific reasons. If actually there is no financial loss, then compensation will not be paid. So therefore, it is said it is only for giving protection. But however, in certain specific life insurance policies, this principle may not be applied. So those kind of policies, only indemnity, there you can say these policies give some kind of return or some kind of profits in the form of bonus or something on the terms of maturity value. So they are exception in nature. So when you be covering those kind of policies, we'll be understanding that certain life insurance policies are not purely based on the principle of indemnity. The primary reason is that it is very difficult or it is not possible to find out what is the amount of loss of a human life. Therefore, it is difficult to decide that how to indemnify. Therefore, life insurance policies are exception. The fourth principle is that a principle of contribution. This is corollary to the principle of indemnity. That means here the situation is that if someone has taken insurance policy from more than one insurance, then again the total compensation amount will be limited to the amount of loss. He may claim it for insurer 1, he may claim it for insurer 2, or he may proportionately claim it for both the insurers. But the total loss amount will be limited. And if a particular insurance company has paid the compensation, let us say company A has paid the compensation, that company has got a right to recover it from the other insurance company B. Okay, so that is one. If you read this particular bullet point, if one insurer pays full compensation, that insurer can claim proportionate claim from the other insurer. So even if multiple insurance policies are taken, the compensation amount will be limited to the amount of actual loss. Okay, this is called principle of contribution. Right? Suppose you say somebody has taken a property insurance of 1 lakh rupees from one company, let us say Tata AIG. Okay. And for another company, let us say you take an example, any example you can take. 2 policies are taken for two different companies. Let us say we say company A and company B. Total loss is, let us say, 1 lakh rupees. Or let us say insurance coverage is 1 lakh rupees and loss is 60,000 rupees. The 60,000 rupees can be claimed in any proportion, 40-20, maybe 30-30, or entire 60 lakh or 6,000 from one company. So like this, one can claim either from one company or both the companies proportionately, or in any proportion. This is the principle of contribution. Right? Is it clear to you, this example? Now, principle of subrogation means substituting one creditor for another. That means, again, based on the concept of indemnity, that no one is allowed to make any profit. Suppose you have been compensated for something. Let us say your vehicle is damaged, or a particular part of the vehicle is damaged. Let us say vehicle lights are damaged, or maybe see a part of the vehicle is damaged. Maybe some insurance companies, they do not cover vehicle lights. But let us take an example. Vehicle lights are damaged, and you are replaced. Insurance company has replaced with new lights. Now, insurance company has got a right to recover your old lights. That is the principle of subrogation. That means the damaged property becomes the property of the insurance company. Once you have been compensated, or the policyholder or the insured is compensated for on the damaged goods, the ownership moves to the insured. Okay, the ownership right of such property is a damaged property, shifts to the insurer. This is the principle of subrogation. Okay, the principle is applicable only when the damaged property has some value. If property is entirely damaged, suppose the house is entirely burned, it has become totally gone, nothing is there, then the principle of subrogation is not applicable because property doesn't have any value. Okay. Now, principle of loss maximization, loss minimization. The principle of loss minimization insists that when loss is happening, the insured should take proper steps to minimize the loss. Suppose there is a fire accident, it's the duty of insured to call the fire brigade, to use fire extinguisher, to throw water on the fire. If he's not doing anything, then he's not trying to minimize the loss. Okay, it is his responsibility to protect his assets. Not that just insurance policy is there, he can sit idle. It's not like that. It is his responsibility to protect the loss. That is the principle of loss minimization. The principle of causa proxima means the nearest cause. So you must have observed insurance policies are taken to cover various kinds of uncertainties. Right. So that means only those uncertainties which are mentioned there needs to be covered. So many examples are coming to our mind for the time being. For example, let us say earlier I had told you this example some other occasion. Let us say there is a fire accident, and let us say house is insured against fire, but the fire has caused due to lightning. Insurance company may say that you see lightning insurance or say the event of lightning is not covered in the insurance policy, therefore compensation will not be paid. Answer is no, because the causa proxima principle says the immediate cause or the closest cause is fire. Okay, due to lightning, fire accident has happened. So because of fire, the property has got property is damaged. So the proximate cause is fire accident. Therefore, compensation can be paid. Right, it's the principle of causa proxima. Another example I had given you, let us say cargoes in the ship was damaged because of seawater entered into it, and the seawater entered because rats have created some food. The insurance company may say rat damaged by rat is not covered, therefore compensation will not be paid. No, that is not again a valid ground, because the immediate reason is that seawater has entered into the cargo, which is covered under insurance. Same thing has happened in earlier, let us say similar kind of thing happened in case of, if I recall properly, at the time of tsunami, several hotels were damaged, and in this seabelt areas, insurance companies say that tsunami was exclusively not covered in the insurance policy. But finally, it was decided that this hotel deserved compensation, because the immediate cause is that this kind of accident, natural calamities which were covered, covered in the insurance policy. So immediate cause is, that is the cause. Okay, so friends, this is how we once again got a fair idea about various insurance policies. So next class we'll be discussing about how these principles are relevant to various types of policy. Today we'll be closing our session here. Next class will be directly entering the types of policy. Okay, friends. Thank you very much.
Thank you, sir.
Thank you, sir.
Thank you.